Welcome. Today we're exploring the core principles from The Boglehead's Guide to Investing, a book that has empowered countless individuals to take control of their financial future. It offers a straightforward, low-cost approach to building wealth, particularly for retirement. This guide isn't about complex strategies or market timing. It's based on the simple, powerful philosophy pioneered by Vanguard founder John C. Bogle. It advocates for a sensible, long-term investment plan that anyone can follow. The fundamental idea is to keep investing simple and costs low. High fees, frequent trading, and complex products erode your returns over time. The Boglehead's approach minimizes these drags on performance. It emphasizes investing in broad market index funds. These funds aim to track the performance of an entire market index, like the S&P 500 or the total US stock market. This provides instant diversification. Because index funds are passively managed, their operating costs are significantly lower than actively managed funds. This cost advantage translates directly into higher net returns for you, the investor. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. Subscribe for more summaries. Time is your greatest ally in investing thanks to the power of compounding. Starting early allows your investments more time to grow and generate earnings that themselves earn returns. Consistency is also crucial. Investing regularly, perhaps monthly through automatic contributions, helps you build wealth steadily. This practice, known as dollar-cost averaging, can also help smooth out market volatility. Don't wait for the perfect moment to invest. The best time to start was years ago. The second best time is now. Get your money working for you as soon as possible. Investment costs, including expense ratios, trading fees, and taxes, are a major drag on your returns. You have direct control over minimizing these costs. Low-cost index funds are the cornerstone of this strategy. Their minimal expense ratios mean more of your investment returns stay in your pocket. Avoid funds with high annual fees. Be mindful of trading costs. Frequent buying and selling generates fees and can trigger taxes. The Boglehead's approach encourages a buy-and-hold strategy, minimizing transaction costs. Diversification is essential for managing risk. By spreading your investments across many different assets, you reduce the impact of any single investment performing poorly. Index funds offer built-in diversification. A total stock market index fund, for example, holds thousands of different stocks. This is far more diversified than owning just a few individual stocks. Consider diversifying across different asset classes, such as stocks and bonds, and across different geographies like US and international markets. Broad diversification protects against unpredictable market events. Market fluctuations are normal. There will be periods of growth and periods of decline. A key Boglehead's principle is to remain disciplined and avoid making impulsive decisions based on short-term market movements. Trying to time the market, buying low and selling high, is incredibly difficult, even for professionals. Reacting emotionally during downturns by selling can lock in losses and cause you to miss the subsequent recovery. Develop an investment plan based on your goals and risk tolerance and stick to it through market ups and downs. Rebalance periodically to maintain your desired asset allocation, but avoid frequent trading. Investing doesn't need to be complicated. The Boglehead's approach favors simplicity. Complex strategies are often harder to understand, more expensive, and rarely outperform simple, low-cost methods over the long run. Focus on the fundamentals, saving consistently, keeping costs low, diversifying broadly, and staying invested for the long term. Avoid chasing hot trends or complex financial products you don't fully understand. A simple portfolio of a few broad index funds is often sufficient for achieving your financial goals. Don't feel pressure to make investing more complex than it needs to be. Taxes can significantly impact your net investment returns. Understanding tax-efficient investing is crucial, especially for long-term wealth building. Utilize tax-advantaged retirement accounts like 401(k)s, IRAs, and HSAs. Contributions to these accounts can grow tax-deferred or tax-free, providing a significant advantage. Within taxable accounts, favor tax-efficient investments like broad market index funds, which typically have low turnover and generate fewer taxable events compared to actively managed funds. Getting started can feel daunting, but it doesn't have to be. Begin by assessing your current financial situation and setting clear, achievable financial goals. Determine your asset allocation, the mix of stocks and bonds appropriate for your age, goals, and risk tolerance. This is a crucial decision that drives your portfolio's risk and return potential. Open the right investment accounts, prioritizing tax-advantaged options. Choose a brokerage known for low costs and a wide selection of low-cost index funds. Fund your accounts regularly, ideally through automatic transfers. Select your low-cost index funds based on your chosen asset allocation. Remember, investing is a marathon, not a sprint. There will be bumps along the road, but by adhering to these simple, proven principles, you significantly increase your chances of achieving your long-term financial goals. Take control, stay disciplined, and build your wealth steadily and surely. Remember, if you like the sound of this book and want a free copy, use the link in the description to get it for free with Audible. Subscribe for more summaries.